there's a lot of economists out there who are mainstream pro-Fed type economists, who have said too high, too long. And even the Fed has stressed since early last month, even Powell gave a press conference where he stressed that staying too high, too long could do damage, even without waiting for the data to prove that it did damage, that it could do damage. And yet he hasn't cut. What's he trying to do? Play a game? And a lot of people are wondering, why not? The job data has not looked good, and not only not looked good recently, but even when you look back at the prior job reports months ago, that were getting worse and worse in terms of, long-term jobs, not the short-term, et cetera. And they've ignored that. And now this Japanese event hit where Nikkei crashed. We have a yen crisis. The yen has rebounded, but it's caused a problem with the yen carry trade thing where a lot of people had positions based on, all that stuff. And a lot of that's unwound, no doubt, recently due to the recent sharp drop of the stock market and the panic. And I suspect we're going to hover around in the stock market and cool things off for a few days. There is one variable out there that I know will kick the Fed in the gut, and that's the banks. We went through this back in January of 2023, the KBE, which is what we watch, the primary one, it's the ETF of the larger banks. It was in January 2023 late, we warned there looked like a crash situation setting up for the banks. Technically speaking, we had no knowledge of any specific banks, And then the stories came out about regional banks and all that, but they did crash. And in fact, in early March, they hit our trigger number, and within about 5 or 6 weeks, they dropped 34%. That's a crash dimension, that percent. It was a little slower than a crash, but still, it was a crash-like drop. The Fed didn't cut them because they were already in the process of raising rates, so they couldn't abruptly stop. But they've now said, okay, we're through raising rates, and they're looking for a reason to cut. And I'm telling you right now that momentum analysis of the KBE is almost precisely the way it looked prior to that March debacle, March, April, May of last year. The problem now is the market can't take it. The broad stock market. Back then, the stock market had already had a major decline in 2022 and was trying to turn up. So when the banks had that drop in March, April, May of last year, it caused the S&P to pull back a little bit. It didn't make a new low, but it was already had been punished. The S&P had. This time around, the S&P has only just now become vulnerable. And so if you kick the KBE through its structures, and they're literally a few percent below the low we saw this week, if you trade those levels, like we traded down to 47 on that ETF, you get down to 46 or much lower, and it's going to start. And I argue that if that starts, it looks like a something that could be fairly rapid, headline-y type stuff. That is a sector of the stock market the Fed will not dismiss. I don't think they care about NVIDIA, but they care about those banks. And if you look at what happened last week on a percentage basis to that ETF and also to the major name banks, the percentage drop they suffered last week and are not really recouping from this week was far more than the S&P suffered. And yet that wasn't a headline. You drop any more and we're going to trigger the banks. Now that's where I think the Fed will do an emergency rate cut. And that is not good for the stock market. If you go back to the 2000 top or the 2007 top, when the Fed started cutting rates, that was a sign they knew something was wrong. So I think we're at that cusp right now. The key is the bank index, the bank sector. And we think technically is very vulnerable to something dramatic. And I don't think it's going to be delayed too long. Why? Because the banks had a huge up month last month. And when you look at the price charts, it impressed a lot of people. Now, they didn't go back to their 2022 highs like the S&P and other indexes were. But they shot up, halfway back up there. They looked really good in July. They erased that entirely in the first days of August. An entire big, huge up month was gone. And so it's moving pretty quickly. And the structures we see were approached so closely. And when I say structures or momentum, I mean, if it were a price chart and you saw what we see on momentum, you'd say, oops, this is going to break down. Okay. We came to suddenly right to those levels. And you may pause for the rest of this week. That's fine. There's justification for that, technical justification. But it looks like it was intent to come down and break those structures. And if you do, I think you'll see precipitous further price decline in the banks. This time one that the Fed will respond to, unlike back in March of last year. And I think they'll justify it. They'll have an argument to do so, And it won't be, something going on in Japan and the Japanese carry trade and all that stuff. This will be domestic. So it's something to watch. Now, by the way, I'm going to mention this because the silver and gold investors are rattled right now, especially silver investors. We'll get on that in a minute. But basically, it's our argument that the monetary metals are in opposite sync now to the stock market. Yes, recently they pulled back, but they've already been pulling back basically in momentum terms since April, May. So it's been several months of congestion for gold and silver and pullback in silver. Meanwhile, stock market only peaked last month. While they were pulling back and pausing, stock market made its high in July. It has broken enough stuff in the stock market to indicate that that asset category is now shifted to a negative long-term status, which is opposite to the major trends of gold and silver. They tend to be opposite. So if you look back and say, well, if the banks are going to crash again, wouldn't silver and gold crash? Well, go back and look at what happened in March through May of last year when the banks dropped 34%. I'd see where are my numbers here. Gold was jumped to $250 in the same time period, and silver went up $7. So it was totally beneficial to them. So I tend to expect that same response this time around in the monetary metals once the banks are triggered. So it's something to watch. We argued back in late March, based on annual momentum of silver, gold, and the gold miners at price levels that are below where we are now. Okay. That the zone of congestion that we'd been in since 2020, where we'd gone up and down in gold, but basically sideways, and silver had descended in a channel, and so had the gold miners. That was over with. We're resuming the bull market that actually began in late 2015 for gold and related markets. Yes, it had a 3-year pause. That happens in major bull markets. Even this one you're looking at now, we're looking at the final 3/4 of a year of the bull market that already began in 2000 from lows in the year 2000. And so we're looking at what I call the acceleration phase at the end of an already protracted bull market. Again, our bull market, we argue, is underway since late 2015. Gold was 1,050 at that time. And we think we've entered the final several quarters of the we call the acceleration phase. Now, this is the silver price action back during that time. Back in August of 2010 and September, as silver moved up toward $20, we broke out enough long-term momentum metrics to argue that the acceleration phase was commencing. And sure enough, you had a nice move. I mean, silver went from like $17, $18 up over 30, similar prices we have now. And then you'll notice the little red lines I've plotted under these pivotal lows on price. So if you're a price chartist, you see this ascending pattern. Well, obviously, when you broke that last red horizontal, you said, oh my gosh, we're in negative zigzag. And so no doubt a lot of people were stopped out and the market got washed out. It dropped from like $32 down to about 26, okay? And spent a couple of weeks down there spinning underneath that last point of breakage. I've circled that level. But it looked negative if you looked at the price chart, that is. But that was a cleansing. It was the cleansing prior to the real vertical portion of the move, which was just a matter of about 3.5 months from late January of 2011 through mid-April of 2011. Silver went from $26 to $50. Boom. But before it happened, it did have that cleansing break. So we suggest that we think we're in that similar situation right now with silver. The bank sector is something to watch because if that happens, obviously, some people will think, gosh, the metals will go down because, the market's going down. I'll go back to March to May of last year and the crash in banks. They went vertical. Okay. I think that next snap we get in the stock market, led by the banks probably, that's when the gold and silver will wake up because they are monetary metals. Okay. And they respond to central bank panics, monetary flows, artificially lower rates, et cetera. That's the fuel behind the monetary metals. And I think at that point, probably sooner, we'll start to see both of the metals firm back up. Now, remember gold, flip to the current charts, if you will, and we'll take a look at that. But look at the gold and silver below it. This is weekly action. Now, what we do here is on that chart, both charts, we circled the September low in 2022. Now, if you recall, back then in gold, it had dropped from over 2,000. And finally there you go. In late 2022, you had this washout that carried down to close to 1,600. Everybody thought it was all over, going to big bear market. And we argued, no, it was a bear trap. Silver at that point in time was down to just above 17 at its low and looked like heck. Okay. And then we surged up out of that low and leveled off in early 2023, In fact, you'll see that spike in silver starting in March. It was about $20. It shot up over 20, 19 something, shot up over 26. That was the time of that bank collapse I talked about. Now go up to the gold chart above. You'll see how it did. It also shot up during that period, during the bank event. And then it went sideways, but firm until early this year. Now there was the surge, the acceleration phase measured by annual momentum again. We argued occurred in March. And you'll see that gold here, in fact, in price, you could see it as well. It shot up over 2,100 and bolted by April. You made a peak close in the above 2,400. That's where the little horizontal red arrow commences at that peak close in April. At that point onward, both metals went into a congestion type process where they were both up and down. In gold's case, it's more or less lateral. If you scroll down to the silver chart, you'll see that its peak in April, peak weekly close that is, was vastly surpassed in May. While gold basically stayed contained below its May peak, silver shot well above it. Silver is what we call a wild dog. And if you're in silver, you have to realize it's a wild dog. In other words, it's got a leash and it's attached to gold, but it's both much stronger than and often seemingly much weaker than. And of course, it was much stronger in that May surge where silver went 10% higher than it had been in April, whereas gold basically stalled at its April high. Now, you can see that the current action, this is through this week, down under 27 even, is below where the April peak weekly close was. We lived above it for a while, now we're below it, okay? Now scroll up to the gold chart and you'll see that it's basically at it. So gold's really more sleepy, but it's steady. Now, by the way, last week's close on gold, that was the new high weekly close. And right now, trading where we are at the moment, we're down about 3% below the peak weekly close of history. And yet people think, oh, gold and silver collapsing. Okay, silver is, seemingly. Gold is yawning, okay, despite the stock market debacle. But I've circled the low in 2022 and the recent high in gold, and I've also done the same on silver. And I want to read you a number, though. Silver looks weak, okay? But from that low to the high, gold went up 54%, silver went up 89%. And even at the current level where gold is right now, as we do this interview, it's up 49% from that low back in September, where silver's up 56%. Yes, silver is a wild dog, but that's the way it behaves. Now, we argue that if you flip up out of here again, and I think we will, silver will be the wild dog on the other end of the leash, pulling gold up. It will be far stronger than gold. Right now, it's weaker than gold over the last month, especially. But that's the way silver behaves, unfortunately or fortunately.